I mean, if you issued this bond when the treasuries were, 5%, and suddenly treasuries are trading at 2%, and your uh, investment quality hasn't changed, you're still going to pay treasuries plus 3, but instead of 5 plus 3, you're going to pay 2 plus 3. So it would be advantageous for you to call this bond. But those investors are going to have to sell those bonds precisely at the moment they don't want to. Because if you buy back my bonds, what am I going to do with that money? A, I can invest it into your new bonds and get only 5%, or I could put it in treasuries and get only 2%. And you want compensation for that. If you want to see the kind of the spreads, there's a database maintained by Federal Reserve St. Louis branch. It's called FRED, short for Federal Reserve Economic Database. If you type FRED St. Louis, you can get the link. And for example, let's look at triple B option adjusted spread. And I'm going to tell you what that option adjusted means. Triple B, this is the rating category by Standard & Poor's. The equivalent for Moody's would be Baa. It's the lowest grade, lowest bond rating you can get, but still considered investment grade. That's important because mutual funds whose express purpose is not to trade on default risk are not allowed to buy non-investment grade bonds. Let's say you're an actively managed fund, you're a balanced fund. That means you're investing a combination of stocks and bonds. You cannot buy junk bonds, anything rated less than triple B, by law. And if you're a pension fund, you can't even buy triple B. It has to be at least double A. But right now, the spread on triple B bonds on average is about 110 basis points. So if it's a 5-year bond and treasuries are yielding, let's make it simple, 4.01, then a triple B rated bond, you should expect 5.20, right? That's the spread. We call it option adjusted because those options have value. So they make an adjustment for that. In fact, one of the concepts we're going to use is yield to call, for example. We normally use something called yield to maturity, but if the bond is callable, we can also think about yield to call, because call price is not necessarily the same as what you want to call same as the face value. If you wanted to know, for example, what's the double A spread, option adjusted spread, that's 51 basis points. Okay. Yes.
Why did the spread increase so much in 2020?
COVID.
Yeah, but what were the circumstances?
Remember, no, it's not about taking on debt. Two factors. One, remember the early days of COVID lockdowns. We didn't know what was going to happen. We didn't know how government was going to respond to this. So if you're holding bonds of relatively less reputable companies in terms of debt, and your perception of risk has gone up. I mean, even with AAA, I mean, let's look at this is double A. Let's look at the AAA. Option adjusted spread. Let's just do 5 years so that we get a little bit better picture. Even the AAA spreads went as high as a little bit over 2. Okay. AAA means there is almost no risk whatsoever of default or not paying the interest rates. But who knew at the time? Remember, it's a period of very big uncertainty. We don't know how severe this pandemic was going to get. We didn't know whether or not there was going to be a vaccine, and how effective was going to be. We had no idea. Whenever there is uncertainty like that, first and foremost, people run away from the risk.
So people got out of bonds.
People got out of all sorts of bonds, even AAA. I mean, normally AAA spreads, I mean, currently it's 40 basis points. Even that's a little bit too high. I mean, why should Apple pay 40 basis points above the Treasury? To me, I mean, yes, Treasury has the opportunity to print money or mint coins, but Apple probably is a safer bet than U.S. Treasury, given the rise of the national debt. Okay, but for example, you can actually see it in. Let's look at the. Let me see. I'm trying to think. Oh, CDS spread for France, for example. Currently, it's CDS is called credit default swap. It has become rather popular in late 90s and 2000s. In fact, it was pretty much the primary way you could buy default insurance. That's why AIG got that business, and they got caught. They thought, AIG is an insurance company, right? So they were gonna use their insurance expertise, and they sold a lot of these credit default swaps. The way these work, let's say I bought a bond issued by France, and I'm concerned that for a lot of different reasons, France may default. France defaulting is different from Apple defaulting. If Apple defaults, you can take him to a US court, bankruptcy court, and it goes from there. What if France one day decides we ain't paying you Yankees? Okay. What are you going to do other than declare a war? That's all you can do because it's a sovereign government, right? So I'm the holder of the French bonds, and I'm concerned. I go to Corky. Corky says, I know insurance. I'm going to get into this business. So I propose a deal for the next. This is a 5-year one. Over the next 5 years, I'm going to pay you basically 33 basis points per nominal. Let's say I have $1 billion worth of French bonds. 33 basis points means 0.33%. Okay, I'm going to pay you. Man, this is how you know I'm sick. I can't do this in my head. times every year I'm going to pay you $3.3 million as insurance premium. But if France defaults, you agree to the following. I bring you those $1 billion of bonds. I say, here's your bonds, give me $1 billion. You make me whole. That's your responsibility as the seller of the credit default swap, as the insurer, if you think about it. So the cost of insuring against French defaulting is 33 basis points. So if you have $1 billion worth of French bonds, cost of insuring that is over the next 5 years to pay $3.3 million a year. All right. You can think of the spreads like that. Okay. I mean, there is also credit default swap markets for corporate bonds, but it's not as deep as the sovereign ones. The AAA companies are paying right now 40 basis points. Essentially, that's the premium, default premium, right? Because presumably US treasuries are not defaultable because they could always mint coins and pay. I mean, if we were talking about the euro-denominated French bonds, that wouldn't have been an issue because France can print euros with the help of Germany and other people and go ahead and pay you. But Apple cannot do that. So that 40 basis points is basically the spread. That spread is the compensation that investors require to carry Apple bonds instead of treasury bonds. And as the ratings go down, for example, let's look at the single B. It's relatively low these days. It's only 300 basis points. Guess how much it was basically during the first week of the COVID lockdowns? That was the first week of COVID lockdowns. I remember because it was right before our spring break. I mean, people were claiming that, oh, we'll be fine. I basically told people we're going to be on Zoom for the next the semester, rest of the semester.